This leads to the non-distorting taxes, that you're going to minimize the decisions and actions of actors in the economy based on the tax rate, which is exactly what you don't want to have. It's a destination-based tax. It simplifies business taxes through the elimination of the corporate income tax, and then replaces it with a one-page corporate activities tax. And we'll look at that form again for Ohio's CAT, which we would anticipate something similar if Oregon were to go in that direction. And then the other issue that always comes in is to maintain balanced treatment between the business entity types. Right now, we're looking at C corporations paying through a whole different structure than our pass-throughs are. And so to keep those two, maintain balance between the two. So in terms of kind of the key elements of the of where the work group ended up, one is to develop a proposal around gross receipts and emphasize a destination-based tax as they do in Ohio. So it will be based on the privilege of making sales in the state. So that would determine a nexus for tax standards. All business entities would be subject to the tax. So there's no differential. It's based on receipts, not on business entity type. Business entities with annual gross receipts less than $150,000 would not be required to file. And you'll see in a minute when we look at some of the numbers, we think there's probably about 100,000 businesses that would have a less than 150,000. This is based primarily on B&O data from Washington, but that would not be required to file under this filing threshold. And then, as is the case in Ohio, you have a rate threshold, and the work group settled on the 1 million level, which is what is used in Ohio. And then a $250 flat amount. So what that means is that the tax under the system would be equal to $250 plus the rate, and this is left blank, as Senator Hass said, with pending discussions, particularly with Ways and Means and some of the other taxes like the provider tax options. But $250 plus percent of gross receipts above $1 million. So if you had $2 million, it would be $250 plus whatever the tax is on that second $1 million. So, and I'll show you some numbers what that looks like in terms of how many firms we think would be affected in those categories. Ohio has a separate, what they call a FIT, which is a financial institutions tax. We would anticipate something similar to that because of the unique nature of financial institutions, and we see this in terms of the corporate income tax now. We would make some rules that would define gross receipts and have them taxed as close as we can to regular tangible property. And then the other issue was gross receipts from the sale of motor fuel. The work group basically made the decision that should be calculated separately and could be part of some other package, but would not be general fund revenue. Some discussions around exemptions, and this would be a key element as you take the next step into a more formal, detailed development of a bill, would be what are the things that should be exempt. What was included here is government transactions. So, for example, the B&O doesn't, in Washington, they don't have broad exemptions for nonprofits. Instead, they exempt a lot of individual components. For example, donations are exempt and not counted as a receipt. If you're a hospital, a nonprofit hospital, they exempt payments from Medicare and Medicaid. So they're governmental transactions. So that's one way